Our final step in the accounting cycle is that of closing entries. This is the end of the accounting cycle. This is when we close the books and prepare for the next period. So the whole goal of the accounting cycle is to get us data to use for financial statements so we have accurate information. Many of the accounts will start the next period with zero balances. Revenues and expenses, we want to know what we earned and incurred that period, regardless of what may have happened in prior periods. There are some accounts that do stay open, however. So the question is, what accounts do we close? What accounts stay open? The permanent accounts, known as real accounts, don't get closed. They keep a balance, versus the temporary or nominal accounts that do get closed down. So the permanent accounts that retain their balance from period to period, these are basically the balance sheet accounts. All of our assets, all of our liabilities, and our equity accounts like capital or common stock and retained earnings. They retain a balance. However, the temporary accounts, which are basically our revenues and expenses and the dividends account, they get closed out at the end of the period, so they start the new period with a zero balance. Those temporary accounts are eventually closed to retained earnings. Now we have a couple of options here that different textbooks and different instructors go through. Option one is the use of a temporary account known as income summary. And the whole goal of the income summary account is just to give you a check figure for what your net income was. So we're not going to go through this in much detail, but option one would close revenues and expenses to the income summary account, because keep in mind, revenues minus expenses is net income. And then we turn right around. As soon as we got a figure in income summary, we would close that out to retained earnings. And then we close the dividends account to retained earnings as well. Option two bypasses that income summary account and it goes straight to retained earnings. So with option two, which is what we're going to see, you would close revenues and expenses to retained earnings individually, each one individually. And then you would close the dividends account to retained earnings, and you'd have a new balance in retained earnings. So let's take a look at how that actually works. Let's start with revenues and expenses first, or revenues first. So let's start with our revenues first. Here we are closing the revenues account out to retained earnings. Now, whenever we hear the term close, what we're basically saying is we're zeroing that account out and moving its balance to another account. So with revenues, we know they start with a credit balance. If assuming we had positive revenues throughout the period, it would start with a credit balance. So to get it to zero, we have to debit that same entry or that same account for $1,500. Now we have a zero balance in revenues. So again, we debit revenues for $1,500 to close it. Of course, we need a credit to this journal entry. The credit goes to retained earnings. As you can see over here, we credit retained earnings for $1,500. And basically what we're doing is moving the credit balance in revenues over to a credit in retained earnings. We're doing it through this journal entry, though. Now, let's close expenses to retained earnings, and it's the exact opposite of revenues. We start with a debit balance in expenses, so our credit entry or our closing entry has to be a credit to expenses. So you can see down here we have a credit to expenses, and the debit is going to be to retained earnings. So notice we already had these other items in retained earnings from before. Now we're debiting retained earnings to close out expenses. Dividends, very similar to expense. It's the same basic journal entry. We start off with a debit balance in dividends, so we have to credit that account to close it. And then the debit to the entry goes to retained earnings. So debit to retained earnings for $200, credit to dividends for $200 to reduce it. Now we have four different things in our retained earnings account. We have a starting balance of $1,300 credit. Keep in mind, retained earnings is a capital account, which has a normal credit balance. We have another $1,500 credit because of closing of revenues. We have a $1,000 debit because we closed expenses. And we have a $200 debit because we closed dividends. In summary, we started with $1,300 retained earnings. We added $1,500 by closing revenues. We subtracted $1,000 by closing expenses. We subtracted another $200 by closing dividends. Our ending balance of retained earnings is now $1,600. That takes us through the accounting cycle. Now we're going to move on to some other topics throughout the accounting section.